This conference will now be recorded.
What is up, everybody? This is Carlos, CEO of GAR Capital. This is our webinar, I guess our weekly webinar, because we're going to start doing this weekly for you guys. Weekly webinar on personal finance. Personal finance. Welcome, everybody. Thank you so much for stopping by. We're here to answer all your personal finance questions. As you know, I always put the questions section on Instagram on the stories, and I get questions from all over. So obviously, I can only type so much in that little box. So this will actually help out to answer everyone's individual questions. Thank you so much for stopping by, guys. Let's go ahead and get started. Fire away with those questions. I'm ready for you guys. 8 p.m. on a Tuesday, September 4th, 2018. Right now, we are showing the futures of the Dow Jones futures right now, down about 10 points. This is nothing to do personal finance regarding this chart, but go ahead and fire away with your questions, guys. Let's go ahead and answer. I'm ready for you. Here's the first question, Gil. I want to get my parents into investing. What steps do you recommend? Okay, so that's a pretty good question, to say the least. Your parents. Okay, first thing I want to ask is about your parents. Tell me about them. You know, what do they fear about investing? Do they have money to invest? How's their personal finance situation? Are they in debt? Do they have an emergency fund? Do they have any kind of apprehension in regards to the markets? That's one of those things that it's all about trust too. You have to give me a little more information, Gil, to let me know so I can give an accurate answer on how to let them know, because it's all about equating their fears or equating to what will get them excited. Because without that is not really a way to kind of let them know how to get into investing. Investing is kind of boring. It's not fun, but again, we try to make it fun by keeping you informed. So information is always key. So let me know if you have more details to that question. All right, next question here. Losing money is their biggest fear. They have around 5,000 to start off with. Okay, so losing money obviously is everyone's fear. I don't think anyone has any issue in regards to losing money. I think no one wants to lose money, obviously. You know, we work hard for our money. So again, you have to kind of speak to them in the sense that it's saving long-term with a better rate of return than a regular savings. We're not in the era of the Great Depression anymore. Obviously, you have to let them know that when you're buying stocks or investing, you're investing in companies, not individual pieces of paper. You're letting them know that, hey, you're putting money in a Coca-Cola, in an Apple, and you're investing in their future, and they're in turn going to reward you with value of the company or dividends. So I would actually recommend more cash flow options, more dividend stocks, so they can actually see a return every quarter, or they're actually getting a check. I prefer that. I think with older retirees or older investors, when they can actually see a tangible return every quarter, it's a lot easier to explain to them that, hey, I'm investing for the future. So keep this in mind. Every dollar you invest, every day you invest is a day that you don't have to work in the future, because money's going to work for you. You're not working for money anymore. Let me know how that works out, Gil. Great question. Next question, type it away. This is GAR Capital's personal finance webinar. Go ahead and type away. After saving a 6-month emergency, this is Chev, excuse me. Chev, welcome. After saving a 6-month emergency fund, what's your view on or saving in gold and silver long-term as a way to beat inflation? Okay, gold and silver, again, these are precious metals. When it comes to gold and silver, you're beating inflation. Yes, you're kind of hedging against inflation. So again, gold is an instrument, obviously, it's never been worth zero. We know this. But the stock market's never been worth zero either. So keep in mind here, when it comes to gold and silver, it's a good way to preserve wealth. I'll give you that. It ain't gonna go anywhere. It's gonna be like basically flat. But again, if you want to preserve money, fine. But again, for that, I'd put in a savings account, FDIC insured savings account. So again, doesn't really make a difference. And I'm still gonna get a better rate of return slightly, but it's still a little more liquid. When it comes to gold, it's a very delicate situation, because when an economy breaks down, and I'll give you an example. When it comes to an economy breaking down, I can give you one example. It was Hurricane Katrina in New Orleans. That was an economy that basically tanked. It was destroyed, obviously, by natural occurrences, weather, hurricane. But again, I didn't see a lot of gold bars being exchanged there. money was being exchanged. A gallon of gas could have got you a lot. A gallon of water could have got you a lot. A car ride could have got you a lot. A working car could have got you. I didn't see a lot of people trading gold bars for water, gold bars for food. So again, gold is a good preservation wealth. I'm not against you having maybe 5% of your portfolio in gold, fine. But again, prepared to not earn anything, it's just going to preserve. For that, I'd rather you have it in a CD in cash, and then you at least have access to it. But that's just my opinion. So again, if I say this, I tell this to everybody: if you like gold, just buy it in jewelry. If you like gold change, fine. Gold watches, fine. I'm a watch guy, I get it. But again, gold stocks, not really. It's a good hedge, but that's about it. Do you recommend joining? Oh, here we go. Now we're getting the questions. Reyes asks, do you recommend joining an investment club through apps like Valeo? Yes. More information, the better. The more people you could speak to, the better. You joining this webinar says that you're serious about learning. Free resources out there. There's podcasts like ours. There's Instagram's accounts like ours. We're not the only game in town, guys. We're here to help, but there's great ones out there that I even recommended. They're amazing, do amazing work. I did a Follow Friday shout out on it. Take a look at it, Friday's post. Those are great Instagram accounts to follow. So keep in mind, any kind of investment club, I'm all for. I'm all for it because you're going to be learning constantly with like-minded individuals. How is that a bad thing? That's an amazing thing. Okay, next question, Robert. Welcome, Robert. I just bought a house. What's the best way for me to restructure my finances? Well, Robert, congratulations. You bought a home. Awesome, awesome, awesome. So the first thing I'm going to ask is, do you have an emergency fund? Number one. Number one, you have an emergency fund. Do you have a budget? Are you in debt other than your home? So let's go ahead and ask that. Let me know what you have on those, and then we can actually go accurately and say forward. Chev, you're welcome. Jay, what kind of risk-reward ratio analysis do your team use for stock options? Okay, Jay, I'm going to stop you right there. This isn't a trading webinar. We're gonna save that question for me, Jay. I want to say that for our trading webinar. Right now, this is personal finance. So again, we're gonna switch that over. So again, I apologize on that. So Jay, just hold on that question for me, and we'll do that over either in my direct message on GIR Capital, or we're gonna do this on a trading webinar. So just a heads up, this is a personal finance webinar, just a heads up. But thank you so much for joining in, Jay. Appreciate you. We got some new attendees here. I have about 8, Robert, continuing his question regarding his home. I have about 8K in emergency funds, and I do have school loans that I'm paying off. Okay, great. So you have about 8K in your emergency fund. Excellent. I like it. And you have school loans. Okay, you're knocking those out little by little with your payments. That's fine. So with your home, again, I don't know how much your home payment is. We recommend that your home payment is not worth more than 25% of your take-home pay. Meaning, if you take home $2,000 a month, your mortgage should not be more than $500 a month. That's just what we recommend. If it is more than that, it's going to be a little difficult. Granted, if you have no debt other than school loans, that's fine, but I would work to get your income up too. Start saving some more and investing a little bit. If you have a home, again, I'm with it. You own it, that's an asset now. For the most part, a home is a blessing, obviously, but just the debt kind of sucks with it, with the mortgage. But again, it's an asset you're building over. Your emergency fund, you may want to pump it up a little bit because remember, you don't have a landlord anymore. If the washer and dryer goes out, guess who's writing that check? If the AC goes out, guess who's writing that check? Dishwasher goes out, guess who's writing that check? That's the key. So again, you're the landlord, you own it now. Any kind of issues regarding the home, foundation issues, roofing issues, you're gonna pay. So again, I would maybe bump up that emergency fund just slightly. I don't know your salary. I always say 3 to 6 months of expenses. Good question, Robert. Gil asks, do you believe the housing market at the moment is strong? Watch The Big Short and traumatize me. Yes, The Big Short back then, guys. That's a great movie, by the way. Excellent movie. 2007. Keep in mind, that's 11 years ago. Was the housing market really out of whack? Yes. Have we had regulatory constraints to prevent this? Yes. Are they perfect? No, obviously not perfect. Again, could this happen again? Sure. And just to be frank, we could have another Pearl Harbor tomorrow. So again, if you're always in fear of what could happen, you're going to miss out a lot of opportunities. Now, again, there's always risk in the market. No matter what you do, guys, there's always risk. So again, it's your job as an investor, your job as a consumer to manage your risk. So again, I don't want you to be traumatized in owning a home. or owning an investment property. Do it the right way. Remember, keep in mind the people that were buying homes then were putting zero down on the home. They were lying about their income on their application. And these applications were given to anybody. If you remember the movie, the guy had a mortgage under his dog's name. His dog's name. Think about that for a second. Not exactly the best underwriting standards, obviously. We don't have that issue anymore. The only issue we have now is that people can't get loans because they're so tight in regards to lending. So again, that's actually a good thing. It could be a bad thing depending on your perspective. But again, don't be traumatized. Everyone, there's opportunities for everybody. Don't be handcuffed or traumatized by what happened before, because just protect yourself. Have cash on hand, emergency fund, make sure you're out of debt. Then you could buy your home. And then if there's an economic downturn, you have cash to back you up. You're not scrambling to sell your home short sale. You're not scrambling because you got laid off, because you have 6 months of expenses to buffer the unknown. That's why the emergency fund is so key. That's why I tell you, have an emergency fund before you even think about investing, because you know what? Let's say you invest and you have a catastrophe at home, whether it's a medical bill or you got laid off. Guess what? You're gonna have to sell all that stock, and guess what? You're gonna pay tax on all those gains. Not fun. So keep that in mind. Good question. Any other questions here, guys? Keep it rolling. Good stuff, good stuff. I love that movie, by the way. Big Short, it's a great movie. Keep them coming, keep them coming. Questions, questions, questions. Personal finance questions. Any other movies like The Big Short you recommend? In regards to finance, there's tons. There's Wall Street, there's Margin Call, The Big Short, of course. Wall Street 2 is pretty good, not as good as the first. I would say a documentary that I really recommend to a lot of people is Inside Job. Great, great movie. So check a look at that one. Andres asks, do you have any favorite books about personal finances? I have tons. Obviously, The Millionaire Next Door, Intelligent Investor is great. Dave Ramsey's Total Money Makeover is great. Those are 3 books right off the rip I would recommend. Take a look at those books. Great, great books. There's one called I Will Teach You to Be Rich. One of my favorite ones too. Take a look at that one. Keep them coming, guys. We're rocking and rolling. You're welcome, Jay. Thank you so much for joining us. Any other personal finance questions? Robert asked, YouTube videos you recommend about personal finance and entrepreneurs who influenced you? Absolutely. I can name you personal finance. I would say my biggest influencer has been Dave Ramsey. I think he's an absolute amazing genius. I love him to death. We may not agree on every single thing, but I think he's amazing. Dave Ramsey's show, he's on TV. Great, great, great. I highly recommend him. Clark Howard is another one. I think he's great. Entrepreneurs, I can name millions. I can name off the rip Grant Cardone. I can name Brad Lee is great. Gary Vee is great. Tony Robbins is great. Those are my 4, I would say. They're my favorite. Follow them. They're amazing individuals. I mean, what more could you ask for than those guys to pick their brain on their YouTube channel or on Instagram? All right, next question, Gil. End of the year taxes, how much does one get taxed on? I live in New NC. How does that work? Tax on losses and gains. Okay, so this is something you need to speak to an accountant, because I don't have state taxes in Florida. Winning. Move to Florida, Gil. I recommend it. The weather's better and there's no state tax. But seriously, in regards to taxes, state taxes, I cannot be accurate. All I know is that when it comes to investing, you're not paying money on gains when you have not closed. When you have not closed your trades. That's why it's good to have long-term capital gains. Leave your short-term capital gains for day trading if you do that with us. And your long-term, don't close it. Just keep them open. Keep them open. And your dividends, reinvest them. So the tax man is out of your pockets. And if you have IRAs, guess what? They are deferred tax. So again, if you have a traditional IRA, they're not getting taxed until when you retire. And then you're putting before pre-tax dollars. So again, you have your wages, then you have your 401k taken out, and then your taxes. Again, that's a big difference on growth. And then you have Roth IRAs, which you'll have your money at the bottom, how much you've netted out, how much the taxes, Medicare, Social Security, and then you take out your Roth IRA. But guess what? You don't pay taxes on that either. And you can take the money out whatever you want, the principal penalty free. But Roth IRAs are not for everybody because they're only offered to a certain income level. So if you're above, I believe, gross income of 220,000, I may be wrong. I'm gonna go actually look it up right now with you guys. Roth IRA limits. Okay, Roth IRA income limits married, if you filed marrying jointly, is 189,000 to the limit. If your gross income falls between 189,000 199,000, you cannot contribute to the limit. That's a heads up. So that's Roth IRA. Again, taxes change every year. If the government loves to do something, is to make things complicated. So again, just a heads up. Good question. Alejandro asks, what advice would you give to somebody that's looking to leave his job to decide a full day trader entrepreneur? Alejandro, the first thing I would say is to save a lot of cash because nothing is guaranteed day trading. You won't have a steady income. You have to understand that you can have a rough month and not make any money. You actually be losing money. So you need to have one or two things. You need to have two things. You need to have an emergency fund, number one, and a very, very big one. I would honestly say about 9 to 12 months now, because you never know what could happen. And you need to be out of debt. That's number two, for sure. And number three, the last part, you need to see how much you're going to be trading with. And it's going to be money that you're not afraid to lose. Okay, being a full-time day trader is not easy. Not everyone could do it. So keep that in mind. Robert, what small decisions can I financially to make a big impact on my financials? Excellent question. Let's do that together. I'm going to show you one called an investment calculator. So let's see if I can find bigger pockets. No, that's not it. Investment calculator. This is it. So let's go ahead, and we talked about this, Robert, in our podcast. Take a look at the podcast on Apple Podcasts and Spotify, GAR Capital official podcast. So you said, what small decisions can I make to do that? So let's start with $1,000, and we're going to add every 2 weeks, every week, $100. Let's just, for argument's sake, $100 a week. Let's say you don't go out to the bar, or you don't go out to eat one weekend, one day out of the week, meaning a dinner or whatever. You save $100. Somehow you cut something out. Maybe you cut the Netflix. Maybe you cut the cable. Maybe you decide, I don't want to watch cable. I'll watch Netflix. That's $100. Maybe you went from Verizon to T-Mobile. T-Mobile gives you half off for the most part, sort of Sprint. Now the actual service may not be that great, but either way. And you put in an S&P 500 fund that averages about 12% rate of return, and in 5 years, you have $37,000 saved. That's $1,000. I just showed you the math. $1,000 you started, $100 a week, rate of return 12% in an S&P 500 fund, 5 years. So again, in 2018, if you started this year, $5,200 is your contribution. You earned $445 of interest. Now you compound. Now this is the power of compounding. 2019, you still started with 1,000. You add another 5,200. The total contribution now is 10,400 total. Your interest earned is now 1,164. You can see this right here. Total interest earned 1,610 because of the addition, and your balance is now 13,000, and it just keeps growing and growing and growing. What percent of the taxes will be upon withdrawal in this scenario? That is dependent on where you live, state tax, and what's your income level. So I can't accurately tell you that. And I don't know how much your write-offs are. If you have write-offs or you have dependents. But I just know that this is a small way right here in order to make a big difference. Now, again, here's the fun. You can just start messing around with numbers. In 10 years, you do the $100 a week, started with $1,000 in 10 years, which 10 years flies by. Right now, you're at, in 2027, you'll have $103,000. Again, these are the small things you could do now. $100 a week. That's $400 a month. Just a heads up. $400 a month, excuse me. All right, Jay asks, the gains and losses does not get taxed after selling a stock if you're in the broker account and other stocks. Correct. Yes, Jay, what you're doing is called the carryover. It's just like selling real estate. If you sell a real estate property and you take that money and buy another piece of real estate, that's considered a carryover because you're moving from investment to investment. But again, you only have a certain amount of days. It's usually 60 days. So again, you may want to check with an accountant because every state is different. Every state is different. Keep in mind, New York loves to tax people. So be very careful. You're welcome, Jay. Thanks so much for being on. Next question here. We're looking at the investment calculator here from the question we had from, I believe, Robert. Again, this is something that I love to talk about, which is investing long term. If you ask me personally what I do, I have 3 accounts, actually 5 investment accounts that I put out money every, 4 I put in every week, 1 I do every month. And I just have money coming out. If I don't see it, I don't spend it. And that's normal. We love spending money, right? I guess I'm a little weird. I like to shop for stocks. I like to shop for companies. A lot of people like to shop for shoes. That's just me. I'm an investor at heart. But yes, money that comes in, I'm either doing 1 or 2 things. I'm either investing in my business, which we have here, our business that we've been growing ever since. If you've been following us, we opened in 2014, or I'm putting it into stocks, or I'm putting it into real estate. So I'm always investing it somehow. I'm always throwing money aside because, like I said, every dollar you're putting away, remember, every dollar you're investing is 1 less day you have to work. And that even includes my business. You know, I love my business, I love my guys, but there's gonna be a time where I wanna work on an island, I guess, or take some vacation. I want my money working for me, not me work for my money. Good questions. Any other questions out there, guys? Go ahead and type them away. Welcome again. Okay, here we go. Chev asks, would you lease or buy a car, assuming you can afford to do both options? Okay, this is a really good question, and there's a couple of things we want to answer here. When it comes to leasing, here's the question: how much are you going to drive the car? Number 1. Number 2, what kind of car you're getting? Number 3, do you own a business? Right? Number 3, and number 4, how much cash do you have? Those are 4 things I need to know. So again, we could do a calculator to confirm both ends. Jay, how long were you trading investing before you became profitable on a consistent basis? Again, not trading questions. We're not gonna do trading questions, obviously. But when it comes to investing, long term, again, in the beginning, I kind of wish I wasn't young and stupid because I got married really young. So again, I kind of withdrew some money in my investment account to, be married and stuff. So again, when it comes to investing, yes, I took a little bit of L's. I wish I would have bought some more in 2007, 2008. I didn't have the cash at the moment, but investing years now. I've been investing now, I don't know, 2009, I guess. That's when I started. 2000 is when I started having a handle my money. No worries. Yeah, when it comes to trading, I blew 3 accounts back to back to back until I finally got a plan and became disciplined. And that was about 2.5, 3 years ago, actually, about 3 years ago. 2.5 years ago, I would say. Any other questions? Type them away. Can't wait for the trading webinar. Yes, trading webinar, we'll go there. Yes, I own a business, 12,000 miles a year, mid appreciation level car. Okay, I'm gonna show you this here. Luxury car. Lease tax deduction 2018. So check this out, Chef. So this is the new tax law. Do you use your car for a small business? The new tax law is for you. Bigger depreciation allowances for passenger vehicles. So again, look at this. You have depreciation based on leases on the car. So again, it has to be a luxury car. So again, good news. You can kind of get in with an Acura, which is probably your lower level lease. Depends on what you want to do. But for the most part, depreciation is going to go up when it comes to business. It's business. Tax law is good for you, he says here. So moving on here, again, every year you see first bonus claim depreciation. If you don't use your vehicle for 100% businesses, the allowances are cut by proportionally. Take a look at this article here. This is on Market Watch. On Market Watch in regards to the tax law. I do recommend a lease if it's for business. And again, just negotiate, make sure you have some cash on hand. But make sure it is a luxury vehicle because the assumption is that you need a lease. You need to lease a luxury vehicle if you're a professional, real estate agent or stuff like that, or a lawyer. Next, Mr. Barber asks, with the markets at all-time high, do you continue to put money in the markets or should you one wait for market correction? That's the question I get constantly, is that everyone asks, oh, is there going to be a market correction or is there what do you call this? A crash coming. I get that all the time. For some reason, people really like bad things to happen, which I understand. I get it. You know, what moves markets is bad news, right? You never get on the news saying, people say everything's all good today. We run on fear. And guys, when it comes to the basic theory of media, mass media, is that fear creates consumption. The more you're afraid, the more you'll consume. That's bottom line what it is. So with that being said, no, I don't believe we're gonna have a market correction anytime soon. Earnings per share is too high. It's high. Profits are high. People are making money. You also have wages are going up. Unemployment is down. I mean, I don't know where the thesis or the basis comes with an all-time high. That means we're going to fall. Markets are still going up. Stocks are still being bought. Where else are you going to put your money? Japan? No thanks. You're going to put it in Europe? No thanks. Russia? No thanks. China? No way. Markets are going down. Where else are you going to put your money? The United States is still the best place to put your money. So just a heads up. Yes, I would put my money to work. Again, if you have a long-term horizon, what difference does it make? Because you're going to be holding on for a while. So even if you get a pullback, you get something called dollar cost averaging. So let's take a look at that. Dollar cost averaging calculator. Let's take a look at this on AMP. So what you would do is lump sum investment around. We'll start with $2,000. Regular investments of $400. And market scenario is variable. Look at the results. So if you invested $400 and each stock was $8, you bought 50 of them. The same $400 in period 2, let's just say you do this every month, it was $6 because it tanked, you bought 66. 400, the price went up to $8, you bought another 50, and then so on and so forth. Let's see if we can make the difference a little better, a little easier. Let's say you had $25,000, 5,000 increments. So let's say each stock, you bought $5,000 worth of stocks at $8 a pop, you bought 625 units of stock or 625 shares. And then period 2, let's say year number 2, the price is at $6, you bought 833. You bought more, even though still the consistency of investment is there. Same thing here, year 3, it was $8 again, 625 you bought. Year 4, 6, 833. You bought 3,541. If you did it all in one lump sum, 25,000, you only got 3,125 shares. So what's better off here? Buying low over the long term or buying 25,000 in one shot? Look at the difference. Period 1, cash value, DCA value, lump sum investment. In periods of thumb, you made an extra $3,333 over the variable market. Lump sum is still 25K, but you bought dollar cost averaging at $23,333. So the average unit price per stock per share, you bought at $7.06. You bought it in a lump sum, you bought it at $8. So you made $3,333 profit by buying over the long term. I've been saying it again, I said it before, I'll say it again. Patience pays off. Patience pays off. Dollar cost averaging, it works. Pretty cool stuff, right? So again, if you want to take a look at this again, it's AMP calculator. I'm going to go ahead and add it to my bookmarks toolbar. Done. And if you really want to get into it, I'll mess around and give you the link again. Dollar cost average calculator on Google under AMP. Take a look at it out. Good stuff. Dollar cost averaging is your friend. Buying long term is your friend. This is why Warren Buffett is rich. Okay? This is why leave the day trading to day trading accounts. Leave that alone. That's day trading, completely different. But when it comes to investing, you're gonna make a lot more investing long term. I promise you, a lot less work. Let the stocks do the work for you, not you work for the stocks. Let them do the job for you. Next question. You're welcome, Gil. Next question coming up here. Excuse me. So let's go ahead and since we're online, I'm going to go ahead and type in best online brokers. Since everyone likes to ask me, what's the best online broker to use? So let's go ahead and take a look according to investors.com. They're going to break down each one. This is Investor Business Daily, top 5 online brokers. So again, you have Fidelity, brokerage, Fidelity here, Charles Schwab, TD Ameritrade, Interactive Brokers, and Trade Stations. So again, these are the 5 that they recommend. I personally use TD Ameritrade. It's my favorite one to use. Again, just works for me. Tons of free, commission-free ETFs. If you're a big trader, take a look at online Interactive Brokers. T. Rowe Price is good. T. Rowe Price is fine. I don't have a problem with it. Those big names, I'm okay with. Again, they're all protected by SIPC. If you guys want to know what SIPC means, Securities Investor Protection Corporation. Think of it as FDIC insurance for your investments. It doesn't protect against your losses. If you buy stupid stock, you're going to lose. But again, it protects you that if the brokerage goes under, your money's not lost. That's the key. So think of it that way. So as long as it has the seal here, SIPC, I'm all for it. A couple things you want to look for an online broker. Ease of use. Is it easy to access? Do they have an online presence? Is it easy to access online? Do they have a mobile app that you can mess around with? If you're into that sort of thing. Number 3, are they SIPC? That should be number 1. SIPC protected. And number 4, is it easy to access your money? Meaning to sell and get out? Do they have ATM access? Can you put money in same day? Do they give you availability same day? These are the questions you should be asking. This is your money that you're putting in. Heads up. Good stuff, Jay. Robert, what are some tips negotiating lower interest rates? Okay, Robert, in regards to what lower interest rates for what? Are you talking about credit cards? What are you talking about exactly? Credit cards. Okay. When it comes to credit cards, best bet, you can always negotiate. Everything is negotiable. So easiest thing you could do is if you have a really good credit score, excuse me, balance transfer credit cards, we can go to a website called Credit Karma, which everyone knows, and you can give you the top balance transfer credit cards. And the people that review these are pretty good. So again, looking here, you want to find good balance transfer credit cards because you can always say either lower my credit card or I'm gonna lose my business because I'm gonna balance transfer you out. So again, for example, Diamond Preferred credit card here at Citibank has 0% intro APR on 21 months from date of the first transfer. So take a look at that. 0% for 21 months. Great. Again, make sure if you do a balance transfer, I'm not a huge fan of balance transfers, but if you do it, make sure to close the last credit card. Do not leave both open because guess what? You do a balance transfer and you spend on that one and then you spend on the other one. Now you have double the debt. I don't want that at all. So again, here we go. Just be very careful. I'm not a big fan of this, but if you have a big balance with a high interest rate and you want to have a little bit of breathing room and you have pretty decent credit, go ahead with a balance transfer. These are a couple of here. Diamond Preferred credit card with Citi, Wells Fargo Platinum Visa, 0% APR on balance transfers, 18%. 0% for 18 months is pretty solid. Chase has a 15-month for 0, and then also Quicksilver Capital One, which should approve you, 0% for 15 months. Pretty good stuff. Okay, Gil, I got debt with credit cards also. Do you recommend putting it all in one account instead of individual interest rates? I was getting the mail, they put my debt into one. Okay, number 1, if they say anything about credit consolidation or credit counseling, no. Credit counseling is a big no-no. I'll tell you why. Credit counseling, if you do credit counseling, which I'm pretty sure that's not your question, but I'm going to go ahead and go over it. I've had this question before. Credit counseling is basically like saying, I need a coach to help me with my debt. Please help me, which is not a bad thing. I get it. If you're really up to your debt, eyeballs in debt, fine. I mean, I still wouldn't recommend it. You just still need to budget and do it yourself. But again, what they're going to do is just do stuff what you should do. Call the credit card company and say, I have too much debt. Please negotiate my prices. Help me make my payments. Yada, yada, yada. The problem is that if you ever go for an FHA or conventional mortgage, it's going to look like you have a bankruptcy on file because it says you need help with your debt. So forget getting a house now. So no credit counseling. When it comes to putting your stuff all together in regards to consolidating your credit card, right? Here's the deal. It's behavior. When it comes to debt, when it comes to personal finance, guys, remember it's 80% behavior, 20% knowledge. So if you're still spending without a budget, and you spend it on one card, my man, you'll spend it on another. You'll still do the same thing. Credit card is a lower interest rate. You need to promise yourself that you're going to cut up the other ones or close them out, because I don't want you putting it all into one and then adding more debt to the others, because guess what? You're taking 5 steps forward and 10 steps back. That's not going to work. That's not going to work. So again, just be very, very careful with that. So again, if you're going to do that, make sure you're on a budget. Make sure you attack these credit cards. I hope that you get an extra job, start Ubering, delivering pizzas, whatever, throw boxes at UPS, something to pay off these credit cards, or any bonus you get at work or any kind of commissions. Start paying stuff off, because I want you to get out of this crap. Get out of this debt stuff, because every day you're paying interest is a day you're not investing. And I don't want that for you guys. Good question. Yes, Jay, exactly. Dave Ramsey talks about this Total Money Makeover. Take a look at it. I got a lot of information from him. I love it. Jay, okay, awesome. Sounds good. We'll talk to you soon. All right, next question here. Questions. Okay, so we were talking about credit cards here. We're moving along. Okay, so let's talk about best online savings platforms. You say you have an emergency fund. You say, Carlos, man, I have an emergency fund. What do you recommend I put my money in? Well, don't put in here. I don't like emergency savings too accessible, because then people start putting everything as an emergency. No, shoes on sale at Foot Locker is not an emergency. That's not an emergency. That watch you really like is not an emergency. Putting rims on your car is not an emergency. Emergency is medical, tires, your AC went out, your transmission went out. That's an emergency. Okay? Not going out with your buddies and getting drunk is not an emergency. Oh, going to the football game is not an emergency. You shouldn't be touching your emergency fund for that whatsoever. You want to go out with your buddies, you budget like everyone else. You budget like an adult. So just a heads up. So here we are. I want to have your emergency savings. This is your emergency savings. And your regular checking account separate. I want them separate. I don't want them in the same bank, because it makes it too accessible. So I recommend online savings accounts. Super fun. You include everything put together. Just a heads up. So again, here's a couple of savings accounts here that I recommend. Goldman Sachs Bank pays 1.85%, $1 of minimum balance. Awesome. Capital One 360 is a 10,000 minimum. Fine, if you want to use that. Pays 1.85. For that, use Goldman Sachs. American Express National Bank, 1.80 if you want it. TIA Bank, 1.80. Look at VO Bank, 2.10. That's the first one I've seen that's broken 2%. There's Citizen Access, Popular Direct, there's Virtual Bank, there's Incredible Bank. That'll give you some decent yields. Are you going to get rich off this? No, you're not going to get rich off this. At least you're going to get some money out of it, get some yield. I'm all about you getting some yield. So just a heads up, if you want to have a savings account, let's take a look at that savings account calculator. Oh, we forgot, we have the, I have the investment calculator here. So again, this is just the savings account. Let's say $10,000. Let's say your emergency fund is 10 grand. You don't add anything at all, and it earns 1.80. This is not great. Again, in 1 year, you're going to earn what, 182 bucks, maybe, if that, $182. And that's if you don't add anything in your savings. Again, it's something. I mean, it's not meant for you to get rich. It's meant for you to have a peace of mind. I just want you to have some money for them to hold it onto for you. That's it. So again, you have tons of access here. Take a look at this. This is the website. It's called bankrate.com, one of my favorite websites. They'll tell you exactly the week averages, national averages for CDs, savings accounts, money markets, and checking. Now you're probably asking yourself, Carlos, what's the difference between a money market and a savings account? Money market just gives you check writing abilities. You don't need that for a savings account. So exit out money markets. You don't need it. So again, let's go here. Jay asked, you mentioned that you have 4 investment accounts. Why 4? These are the 4 that I have. I have 2 with I have 1 with TD Ameritrade, 1 with Ally Bank, 1 with Vanguard, and I have Fundrise. Fundrise is my real estate holdings. It's a REIT investment trust that I put money in. Ally Bank is my stocks, the top 10 stocks that I have, the top 10 stocks we put out there. I invested in all those, and I still have those. I still add money. Anything that I consider speculative long term, I want to hold on to just stocks that are not ETFs or mutual funds, it's in that account. You know, the Squares of the world, the Home Depots, the Apples, AMD sort of thing. TD Ameritrade, I have another TD Ameritrade. Why do I have two brokerage accounts? Two, because one of them is my options account, which I guess you consider five, and the other one is a dividend account, which is only stocks that hold dividends. I like to have them separate. I don't want everything in one place. I don't want my eggs in one basket. And the other one I have investment accounts 1, 2, 3, 4. I think that's five. That's five. That's where I have five. Fundrise, two TD Ameritrades, an Ally Bank, and a Vanguard. The Vanguard is my S&P 500 fund. Again, what did I talk about? $30,000 in S&P. Exactly. I have about 35,000 in that, and I had that separate. So again, my S&P 500 fund, guys, is in Vanguard. It's called I forget what it's called. S&P 500 fund. You can look it up. Now I'm going to make me look it up now. S&P 500 Vanguard fund. You see here, so you can take a look at it. If you're interested in the S&P 500 fund, this is the one. VFINX is what I have, and this is called a prospectus. So again, anyone can look at this at any time. And if you invested $10,000 in 2008, look at here, hypothetical growth since 8/31/2018. Right now, you're at 26,835. Just a heads up. That's where we are. Now again, very, very low expenses. This is the S&P 500 fund, and you probably say to yourself, what does it hold? It holds Apple, Microsoft, Alphabet, which is Google, Amazon, Facebook, JP Morgan, Berkshire Hathaway, Warren Buffett, Johnson & Johnson, ExxonMobil, Bank of America. These 10 right here. If you own the S&P 500, you own these stocks in that group. So I have about 35K in that personally. So again, I practice what I preach, guys. If I have an S&P 500, I told you guys, S&P 500 fund, get that up to 30 first, 30,000 first, then start doing individual stocks. That's what I meant. Just a heads up. Okay, so moving on. What is the name of the website? Alejandro, which website? Mr. Barber, what is my morning routine? What are your opinion on robo investment accounts? My morning routine is simple. Wall Street Journal in the morning, Twitter in the morning, check in with my guys, my team here from this desk here. I check in with our pre-market when it comes to day trading. I don't check my investment account every day. It's not necessary, but I want to see the news. Read the news daily, and I'm between two iPhones, keeping our clients up to date on Twitter, keep them up to date on the chat room. That's my morning routine, and a lot of coffee. Thanks, Mr. Barber, for the question. Gil to all, what about I-bonds? I invested some money like 3 years ago when I did my taxes. Do you think it's a good place to put money? When it comes to I-bonds, if there's a bond I like, it's muni bonds. They pay a little more. So let's take a look at muni bonds, municipal bonds. There's a couple of ways you can mess around with bonds. Again, if you're older. So let's go to municipal bond yields. So let's go ahead and take a look at municipal bond market yields. You can always go to a couple of different ones. So there's a couple one you want to be careful with, but again, you're just investing in cities for the most part. So again, you have municipal income funds that you can just invest in ETFs instead of just buying the complete bond itself. So again, there's a couple of them. So let's see, let's say the bonds and rates. If you want to do an investment bond in treasuries, that's the safest, is the United States backed. Again, you're talking about, you know, a 10-year is now paying 2.88%, 2.89% yield. So just a heads up. There's different ones for different muni bonds. If you buy a 30-year, it's 3%. Now, there's a couple of them. Now, there's a one that gives you a little bit of a tax break. Tax-free municipal bond rates. So you can always do a couple things. You can always buy municipal bonds that are tax-free growth. So just a heads up, there's different states that have them. So again, if taxes are a big deal, just a heads up, you can always invest in treasury bonds, but again, they're paid so low. So again, I'd rather you own dividends for that. So if that's the case, you could do tax-free municipal ETFs, and you could actually come here to ETF database, and there's a couple here. There's a couple here. Year to date, look at it. Look at the year to date on it. You're not going to get much. These are high yields, but again, the higher the yield, the more the risk. More risk or default. It's like lending your uncle who's broke money. You're probably not going to get that money back. There's a couple of cities in America, Stockton, California rings a bell, where they're just broke and they're probably not going to pay back their bond holders. Same thing with Chicago or the state of Illinois. The state of Illinois can't even pay back their lottery winners. So I'm probably not going to invest in Illinois bonds anytime soon because their interest is high. Another example, Argentina. Argentina can't pay their bills because they have hyperinflation. So what are they going to do? They raise the rates. So again, you may get a high 18% yield, but again, are you going to get paid back? That's really up to you. And I don't think I want to risk my hard-earned dollars on it. So just a heads up. So let's see here. Good question, Gil. I didn't know that information. How much dividends you receive from the 35,000 ETF? I think it's quarterly. It's about 1.3, very low, and I don't even look at it. Honestly, for the most part, it's all reinvested, Chef. He asked, how much dividends do you receive from 35K in the S&P 500? It's very minimal. I honestly don't even look at it. Admin, going back to Fundrise, how much money do you put aside for real estate investments? I put in just to start really low, like $1,000 because I didn't know about it. I just started slow, kind of ease into it. I kind of wanted to see before I start putting more money into it because I'm a big stock guy. So again, I wanted to try it out. I put in honestly $250 a month. I just put that. I'm probably going to add more. The more it grows, I want to see exactly how it is. But if you want to see the website, I'll show you right now. If there's one thing, I'm probably going to buy one more real estate ETF. It's Grant Cardone's Cardone Capital. I'm going to get into that too. Annual returns are pretty sexy when it comes to Fundrise, as I could see. It's not exactly liquid. You can take your money out whenever you want. I think there's a certain period of time. I'm going to be investing in, I have invested in this. I'm going to invest in Cardone Capital too. So Cardone Capital, Grant Cardone is someone that I actually look up to and I want to invest with him. But right now his fund is closed. So when he actually opens up, I'm writing him a check so he can invest my money in real estate. I actually have his book, great book too. It's a cash flow real estate. Take a look at it. Excuse me. Good questions all around. But yeah, when it comes to the S&P 500 interest, I mean, it's not tons of money. I mean, it's mostly just for growth. Good stuff though. Any other questions, guys? Good questions all around. We talked about savings accounts, right? When it comes to bank rate, guys, again, questions, you can always take a look at mortgage rates. Very good stuff. Also refinance rates. So again, you can always use this calculator to tell you exactly how much is the rate. It tells you how much the fees are. Bank rate is a really great way to get started when it comes to if you're looking for a home. Looking for a home, again, guys, a couple things I recommend. No more than a quarter of your take-home pay in your mortgage costs. Just keep in mind, it's pretty, when it comes to buying a home, it's not as simple as buying a loaf of bread. There's principal, how much you have to pay back in the home, the loan, interest, got to pay interest. Number 3, escrow. You probably say to yourself, Carlos, what the hell is escrow? Well, you got to pay taxes. Homeowner association tax, you got to pay taxes for the property tax. And people don't trust you to pay taxes yourself because most people, just like anything else, are not going to be good savers. So what they do, they escrow, meaning they roll it into the loan. So you pay an extra $200 a month to make sure you pay $2,400 a year in taxes. The bank holds that money and they write you a check at the end of the year so you can pay your taxes. That's what we call escrow. Very fun stuff until you need the money. And that money is meant for taxes. And you better pay your property tax or the government's going to take your home. Even if you're current on your mortgage, even if you own the home outright and don't even have a mortgage, you better pay property taxes, boys. Because if not, the government will take your land. That's the beauty of government intervention. Nothing is free, guys. Just heads up. So again, bankrate.com is a great way to get started when it comes to if you're looking to get a home. But again, always take a look at getting a mortgage broker and a real estate professional to help you out with anything in regards to your home. Good stuff. Any other questions here? I like that S&P 500 idea. I'm going to start putting $100 every week. Is that a good game plan to grow my money? Gil, absolutely. Let's go over one more time. Let's say you started with $1,000, Gil, and you added $100 a week. Excuse me, $100 a week. I wish 1,000. And it pays historically 12%. In the same 1 year, you're going to make out with $6,645 on the balance. Now, granted, your contributions were $5,200. You made about $445. Now let's open it up to 5 years. Now you're at 37,000 because you contributed $26,000 in 5 years. Interest earned is $10,000. As you can see, the investment growth over time. Only thing is added is $100 a week. $100 a week is not a big bite. You're not going to feel that unless you're a really tight budget. Again, I can't really say $100 is a lot. It's not a lot of money because everyone's different. I don't want to put down anybody saying $100 is not a lot of money because I'm not some elitist. I'm just here to help. But $100 a week, guys, that definitely will make a difference in your saving. But $100 a week, I could tell you millions of ways people waste $100 a week. Number one, food. Brown bag the food. Eat out a couple times. That's my problem. I eat out a lot. That's my problem. But again, I budget that because I like going to restaurants. But again, think of it one time, a couple days a week that you don't go out to eat and you bag your lunch to work. That's $100 or whatever. Put that in an investment account. In 5 years, you'll see your account grow to $37,391 when you started with $1,000. No, Jay, I still contribute to the S&P. Of course, that's the main deal. You still contribute it. I'm just saying that now I can move on to individual stocks too. I don't want people to go into individual stocks with $100. That doesn't do anything. So again, I want you to do the S&P 500 fund. I want you to have diversification and still have a ton of companies in the palm of your hands so you make some money. Just to finish Gil's question, in 10 years, when you still consider, and the best thing, guys, is that when you create this habit of saving, you're going to be making so much money because now you've created this habit. And $100 is not going to mean anything to you anymore because you're paying yourself first. You're paying yourself first. I want to make sure that resonates in your head. $1,000 to start, $100 a week, 12% rate of return on the S&P 500. Historically, 10 years to grow, $103,000. Take a look at it. Simple. I just made it simple for you. Let's say Carlos, it never did 12%. You're crazy. Okay, I'm going to go 8% because you just want to be that guy. Okay, 81,000 now in 10 years. Name me 5 people that you know that have $81,000 in cash right now. I bet you couldn't name 5. Well, you're going to have it because you listen to this. That's why. And you listen to this webinar. $100 a week, guys. Make it happen. If you care about personal finance. If you don't, then keep doing what you're doing. You're going to keep getting what you're getting. Okay, so question. Amin, can you explain the difference between the tickers SPY and SPYG? SPYG is just the same thing as SPY, except it's a little cheaper. And the only reason is that it's just a different mutual fund. SPYG here, as you can see, is the S&P 500 growth ETF, is which I've been recommending. 1.54 yield. The best part about SPYG, guys, is that it's commission free on TD Ameritrade, meaning you're not paying $6.95 a trade per. You're not paying $6.95 per trade on SPYG, meaning you could buy one share of $38.06 on TD Ameritrade and not be charged $6.95. Whether it's 1,000, or 1,000,000 shares, you're not paying a fee. It's commission free. I like free. I hope you do too. I hope you do too. So again, SPYG, I'd rather you do it. When I say SPY, it's the S&P 500, yes. But again, it's more for stock options purposes. We're not going to get into it. It's just the SPY ETF. So again, SPY ETF, you can see here, costs a little more, 281. But again, the volume is a lot higher. More people trade the SPY than they would do SPYG. So that's why I trade this in options. Think of this, SPY in options, SPYG investing. So much easier. Think of it that way. Next question. What do you prefer, renting or owning? I prefer renting because I'm a single man and I don't want to own a home when it's just me. Before I know it gets haunted. I'm kidding, it's not gonna get haunted. But I'm saying that I just don't need that much space. So I live in a high rise in downtown Miami, excuse me. I live in a high rise in downtown Miami. Just works for me. Again, I pay my rent, I'm happy with it. Whatever works for you. Again, if you have a family and you want to own a home, I'm not against you owning a home. What I am against is you having this insane mortgage because you need a 5-bedroom mansion. You don't need a 5-bedroom mansion if you cannot afford it. If it is more than a quarter of your take-home pay, I'm going to be watching you every time you pay that mortgage payment because money out of your pocket that you can't invest. So again, there's 2 types of people in this world. Those that are paying interest and those that are collecting interest. Which one do you want to be? So heads up. Good enough for me, Gil says. Oh man, I like the idea very much. Me and my wife will get on this week. Thank you so much for this great info. Gil, you're very welcome. Thanks so much for stopping by. Amin says that clears up. Great. Jay, after investing $100 per week in S&P and getting to 30K, how do you recommend jumping individual stock with the same $100 a week? Would you drop the S&P contribution to $50 a week and then use $2 a week individual stock? I like that idea. Or Or maybe because you like investing so much, you keep the $100 in S&P and you start saying, I like saving so much, I want to put another $100 into my personal account to invest. Hey, fun thing about investing, you get more money, you start like doing stuff when you're actually really good at it. I've noticed when people do really good things, they want to keep doing it. So when you see that account keep going up historically, and in 10 years you have 100K or 80K because you put $100 a month away or a week away, guess what? You're gonna want to do it again. That's the great part of it. And I'm not saying that you're gonna live under a rock forever. No, take some profits. You want to close something? That's fine. You're gonna pay taxes, cool. But again, it's money that you're gonna have. It's money you're gonna have, man. You're willing to pay the price now to pay any price later. Thank you very much, Grant Cardone, for that quote. Robert, the S&P investing you are talking about, where can I start that up? Very simple, tdameritrade.com. So I'm gonna give you the website here, tdameritrade.com. And you're gonna go to right here. And you can always go to pricing on TD Ameritrade, $6.95 per equity trade. But here's the best part. There's commission-free ETFs. So I'm gonna go to commission, if I can spell, ETF, TD Ameritrade. Again, I do not get paid a dime from TD Ameritrade. I'm just telling you what's easier. So again, top 97 free ETFs on commission-free TD Ameritrade, meaning you will not pay a dime for trading the stock. Whether you buy or sell, you're not paying $6.95 both rounds. If you bought a regular stock, you want to buy, you want to sell 10 shares, 100 shares, 20 shares, you have to pay $7 to buy, $7 to sell. That's $14 every time. Maybe that to you is nothing, but it adds up. It adds up every time you buy. So take a look. All these right here, take a look at this website, etfdb.com, gives you all of these right here, guys, on this page is commission free, meaning you will not pay a dime. I want to say that one more time. You're not going to pay a dime. So let's look for SPYG. You should see it here, if I can find it. Excuse me. The asset class, equity. It's an equity fund. SPYG, number one. Maybe we should come up here. Oh, let's look at volume. Maybe the average volume is best. SPYG. Stay with me a second. Well, either way, it's there. I'm trying to look for it, but I can't find it. So this is the ETFs that TD Ameritrade offer for free without a commission. Think of it as Robinhood. You want to think of it that way, but way better platform. Without a question, way better platform. So again, you could type in SPYG, TD Ameritrade. Yeah, pretty easy. Research TD Ameritrade, ETF profile. What does it say right here? Available commission free. Learn more. All these here, guys, are all free TD Ameritrade. No charge to you. I don't want to hear excuses. You can do this, okay? And you have plenty of opportunities here. You have bond funds. You have sector funds, international commodities, all commission free. Does that mean you should just buy blindly? Absolutely not. You should be researching. So TD Ameritrade, you could put $1 in today, a freaking dollar, and you have access to all this. You could start looking exactly at trailing returns. Look at this 10-year SPYG. What did I say it was? 12% on the calculator. 12%. Okay, 12% on the calculator. You see it? 12%. I'm not making this up here. Right there. Standardized returns, 10 years, SPYG, 12%. Look at the companies in it. Apple, Microsoft, Amazon, Facebook, Google, Visa, United Health, Home Depot, and Boeing. You buy this, you own this. This is yours. And God help you if the stock market goes down, because we already talked about that. It's called dollar cost averaging. And guess what? We already said you make more when it goes down because you have a plan. Hey, what a great concept. You have a plan. Wow, how awesome. Awesome. Keep going. Next question. So much good information that I'm going to have to watch this video again. Is this going to be on the YouTube account? Yes, Robert, this will be on YouTube. This will be on YouTube. Dumb question here about the S&P investing you're talking about. Can you do the same with NASDAQ? Yes, you can. I'm okay with it. Problem is not commission free. I like free. So again, you could do this. You could do a sector fund. You could do the NASDAQ retail ETF if you wanted to. There's different ones here. But for the most part, equity, I mean, you can literally put it as expense ratios and stuff like that. Your best bet here, if you want to do a NASDAQ or like a tech heavy fund, there's a couple here. Let me see if I can find some. I should have a tech one here. This is NASDAQ Bank ETF. Listen, how about this? You like pharma, let's say you like semiconductors. You say, man, Carlos, I'm telling you, man, Bitcoin and autonomous driving. I love me some AMD. I love me some NVIDIA. I love Micron and Applied Materials. But Carlos, NVIDIA is so freaking expensive. And I don't want to pay and just be in one share of that. Great. Well, guess this is pretty good for you. This is the First Trust NASDAQ Semiconductor ETF. Guess what stocks you're going to own if you're in this. You own Texas Instruments, Micron, Intel, Quovo, Integris, Marvel Technology, and NVIDIA's on there too. And look how much you're going to return in 1 year, 27%. Again, this is if you want to buy semiconductors and you're just not going to put it all in NVIDIA. Again, there's different funds for different people, different strokes for different folks, right? And these are all free, meaning that you're not paying a commission. Let's say you like pharmaceuticals, let's say you like internet companies, let's say you want to do a smartphone index, there's tons of biotechnology, whatever, they have it. If the market goes down, what do you recommend? Alejandro says. Let's go back to dollar cost averaging. I love it. So let's say, Carlos, the stock market goes down. Let's say you invested 25,000, let's say 30,000, right? Into the S&P 500 fund. And it's variable, meaning the market is going crazy. It's up and down. So I think we can mess around with this. How do I mess around with this? Okay, unit price over time kind of, I don't think I can mess with it, just a heads up. But here, either way, I wish I could. Fine. So $30,000 in the S&P 500 fund, right? So you have two options. You can either buy all up front, or just like we talked about, every week you're putting a little bit of something, or every quarter or what have you, every year. You go to number two here, $30,000, that's $6,000 for 5 years, let's just say. 5 years, you put $6,000 instead of putting 30,000 one front. Let's just make sure and say that the S&P 500 fund that you have, you bought it at $8 each. That means you have 750 shares. Let's say it goes down to $6. It tanked. We had a recessionary period. Guess what? Or it tanked because of whatever. Now you have 1,000 shares. You still the same investment, the same $6,000. And then next year it bounces back. Guess what? Instead of buying 1,000 shares, you bought 750. Let's say the next year it goes back down again. Guess what? You bought 1,000 shares at a cheaper price. I want you to get in cheaper. You're getting it at a cheaper price. That's a good thing. You're buying at a sale. And then it goes up again, you're buying at that price too. So the comparison here, if you bought in one shot, 3,750, let's say everything just stayed consistent, nothing changed. You made more money with falls than you did on rises. Right? Saying to yourself, well, how does that work? Well, because you bought in cheaper, $4,000 are made compared to 3,000. That's about 11%. Well, about 14%, let's just say. Because you bought on dips. Stay consistent with your plan. The market's going to change no matter what. So what? No one ever made a dime panicking. You're going to consistently do what you do. Investing in quarters every 3 months. Yes. Index fund S&P 500 equal weight no load shares. Yes, you could do that too. If it's S&P 500, I'm fine. If the market goes down, what do you recommend? This is what I recommend. Dollar cost averaging. You bought each one for $7.06 in comparison to $8. Now you own a lot more stock, $4,250 in comparison to $3,750. Your value is $4,000 more. You made $4,000 profit. You should be excited if the market tanks because now you have cash, you have emergency funds, so you're not worried. You have a buffer. This is why we talk about emergency fund. Number two, you have cash to invest now. You're not paying interest to stupid credit cards. You have money in your hand to buy stocks cheap. Let's have some fun. 2007 stock prices. Hello. Let's see. Let's say Bank of America, 2007, historical prices. Oh, I don't know. Let's see. Let's do max. Let's do 2007 to 2008. Done. This is on Yahoo Finance. I'm looking at 2007, 2008, right? Here's the prices. Opened. 2009 is actually when the markets are really taking a hit. 2009. 1, and say 2010. Apply. Okay, beautiful. 2010 was really, we were taking a hit, right, guys? 2009, look how much you could have bought Bank of America for. You could have bought Bank of America in 2009. Oh, I don't know, February, this is all legit here, February 3rd, 2009 for $3.95. $3.95, are you kidding me? You could have bought Bank of America. But you probably didn't because you were in debt. You didn't have cash. So where's Bank of America today? If you had dollar cost averaging back then, look how many days, weeks, $3, $5, $8, $7. Look at it today. $31. Make a decision that your future self will thank you for. Period. Yes, TD Ameritrade, that's the name. Which is best? I like every week. Whatever makes you invest without you feeling bad about it. Every week is fine. Jay asked, which is best, investing every week or every quarter long term? Yes, that's the one, Gil. SPYG, TD Ameritrade. If you go to TD Ameritrade and sign up, you can sign up for a freaking $1 and you can look up commission ETFs. Hello, right here. And then you just pick and choose what you want. Oh, here we go. Asset allocation, dollar cost averaging with no commissions. I thought we just talked about that. This is how to build wealth. This is how to build wealth, guys. I broke it down for you. Again, this is your opportunity to crush it, to create a legacy. This is your opportunity now. I've given you the tools that you need. We've gone over a bunch of things, and this will be on the YouTube channel. All right, guys, we'll leave it at that. It is now 9:07. It's been an hour. Been a very fun hour. Thank you so much, guys, for joining me. My name is Carlos Garcia. I'm the founder and CEO of GAR Capital. I will let you know when we have the next webinar. It will be a trading webinar. Hello. Can't wait. Love you guys. GARCapitalFX.com is the website. GAR Capital on Instagram. GAR Capital on Facebook. Give us a like. Give us a subscription on YouTube. We appreciate you guys. Have a great, great rest of your evening. We'll catch you soon and wish you the best of luck on all your future endeavors. We'll catch you guys soon.